Welcome to our mathematical finance lecture. Today, we are diving into the fascinating world of option trading strategies. If you have ever wondered how professional traders manage risk or how they can make money even when they do not know which way a stock will move, you are in the right place. We are going to build your understanding from the ground up. So let us get started. Now that we know our topic, let us understand what an option trading strategy actually is. Imagine you are at a buffet. If you just eat spicy curry, it might be too hot, but adding yogurt perfectly balances the heat. In financial markets, buying a single stock or option is like eating just one ingredient. It might expose you to too much risk. Option trading strategies are like creating that perfect combo meal. By mixing different financial ingredients like buying one option, selling another, or holding the stock itself, you can custom build your exact desired balance of risk and reward. You can even bet on how much a stock will move rather than just its direction. With the basic idea of mixing ingredients in mind, let us look at our first specific recipe, called the covered call. Imagine you own a house that you're not living in, and you decide to rent it out to collect monthly income. A covered call is the stock market equivalent of renting out your shares. You already own the underlying stock and you sell a call option on that exact same stock to someone else. By doing this, you receive an upfront cash payment called the premium. If the stock price stays flat or goes down, you keep the premium as extra income. However, if the stock price shoots up, you will have to sell your stock at the agreed strike price, which caps your maximum profit. Now that we understand the concept of renting out our stock, let us look at the mathematical formula that calculates our profit. The total profit, denoted by the Greek letter pi, is made of three parts. First, the final stock price minus the initial stock price represents your profit from just holding the stock. Second, we subtract the maximum of the final stock price minus the strike price, or zero. We subtract this because we sold the call option. So if the stock price rises above the strike price, we owe the buyer that difference. Finally, we add the premium, C, which is the cash we collected upfront. If the stock price increases beyond the strike price, your stock gains are perfectly cancelled out by your option losses, capping your profit. Before we move on to the next strategy, let us see this formula in action with a concrete example. Suppose you buy one share of a company at $50. You want to generate some extra income, so you sell a call option with a strike price of $55 and you collect a premium of $2. We want to find your total profit if the stock price at expiration is $60. We start by substituting our known values into the standard profit equation for the covered call. The final stock price is 60, the initial stock price is 50, the strike price is 55, and the premium is 2. This sets up our calculation perfectly. Continuing with our calculation, we break down the equation into its individual parts. First, we look at the stock itself. The final price of 60 minus the initial price of 50 gives us a $10 profit just from holding the stock. Next, we evaluate the call option we sold. Since the final price of 60 is higher than the strike price of 55, the option is exercised against us. The difference is $5, which becomes our liability. We must subtract this $5 from our $10 stock gain. Finally, we still have the $2 premium we collected upfront, which is ours to keep no matter what happens. Let us wrap up this calculation to find our final net result. We take our $10 gain from the stock and subtract the $5 we lost on the option contract. This leaves us with $5 in net capital gains from the price movements. We then add the $2 we collected upfront as the premium. 5 plus 2 gives us a final profit of $7. Even though the stock went up by $10, our profit was capped because we had to sell the stock at the $55 strike price. However, we still made a solid, guaranteed return, which is exactly why conservative investors love this strategy. Now that we have seen how to generate income, let us look at a strategy designed purely for safety, known as the protective put. Imagine you just bought a brand new expensive car. The very first thing you do is buy car insurance so that if you crash it, you do not lose your entire investment. A protective put is exactly like buying car insurance for your stock. You buy the underlying stock and at the same time, you buy a put option on that stock. This put option gives you the right to sell the stock at a guaranteed strike price, no matter how low the actual market price falls. You pay a small fee upfront for this protection, but it guarantees that your worst case loss is strictly limited. Let us translate this insurance concept into a mathematical formula. The total profit, pi, starts again with the final stock price minus the initial stock price, representing your gain or loss on the stock itself. Next, we add the payoff from the put option, which is the maximum of the strike price minus the final stock price or zero. This term only has value if the stock price drops below the strike price, acting as your insurance payout. Finally, we subtract P, which is the premium you paid out of pocket to buy the put option. If the stock price crashes, the put option payoff perfectly offsets the stock's losses, meaning your maximum possible loss is capped at the cost of the insurance plus the difference between your purchase price and the strike price. To truly understand how this insurance works, let us look at the payoff graph for the protective put. On the horizontal axis, we have the final stock price, and on the vertical axis, we have our profit or loss. Notice the solid blue line? On the left side, the profit line never falls below a certain flat floor. This flat floor represents your maximum possible loss, which is strictly limited by the put option. No matter how far the stock price drops to the left, your loss does not get any worse. On the right side, once we pass the strike price and the break-even point, the line slopes upward forever. This shows that you still get to enjoy unlimited profits if the stock price goes up. Now that we have visualized the safety net, let us calculate a real worst-case scenario. Suppose you buy a share of stock for $100. You are worried about an upcoming earnings report, so you buy a put option with a strike price of $95 for a premium of $3. Unfortunately, the company reports terrible news and the stock price crashes to $60. What is your total profit or loss? We start by substituting our values into the protective put formula. The final stock price is 60, the initial price is 100, the strike price is 95, and the premium paid is 3. This sets up our calculation to see how the insurance performs. Continuing with our calculation, we evaluate the damage and the insurance payout. First, the stock itself dropped from 100 to 60, giving us a devastating loss of $40 on the stock position. However, the market price of 60 is far below our guaranteed strike price of 95. Because of this, our put option is highly valuable. We calculate 95 minus 60, which means our put option pays out $35. This $35 value will save us from taking the full loss on the stock. We plug these numbers back into our equation, remembering to subtract the $3 we paid for the insurance. Let us find our final net result for this disastrous market crash. We combine the $40 loss from the stock with the $35 gain from the put option. This leaves us with a net loss of $5 on the investment itself. We must also subtract the $3 we paid for the option upfront, out of our own pocket. -5 minus 3 gives us a final net loss of $8. While losing money is never fun, compare this to what would have happened without the strategy. If we had not bought the put, we would have lost a massive $40. The protective put did exactly what it was supposed to do, saving us from a catastrophic financial disaster. We have covered income and safety. Now, what if you know a stock is going to make a massive move, but you have absolutely no idea which direction it will go? Imagine a pharmaceutical company waiting for government approval on a new drug. If approved, the stock skyrockets. If rejected, it crashes. A strategy called a straddle is perfect for this. To build a straddle, you buy both a call option and a put option at the exact same strike price and expiration date. You are essentially betting on pure volatility. If the stock stays flat, you lose the money you paid for both options. But if the stock explodes upward or collapses downward, one of your options makes a fortune. You do not care which way the market moves as long as it moves violently. Let us look at the mathematical engine behind the straddle. The total profit, pi, is the sum of the payoffs from both options, minus their costs. The first term is the payoff from the call option, which makes money if the final price is higher than the strike price. The second term is the payoff from the put option, which makes money if the final price is lower than the strike price. You subtract both C and P because you had to buy both contracts upfront. Because it is impossible for the final stock price to be both above and below the strike price at the same time, only one of these options will ever pay out at expiration. Therefore, the winning option must generate enough profit to cover the combined cost of both premiums. Before we conclude, let us understand why these strategies matter in the real world. Option trading strategies are the backbone of modern risk management in financial markets. Without them, investors would be forced to take on binary, all or nothing risks every time they bought a stock. By combining options, massive pension funds can protect retirees' savings from sudden market crashes using protective puts. Hedge funds can generate steady, reliable income in flat, boring markets using covered calls. Even airlines use similar combination strategies to lock in fuel prices, ensuring that a sudden spike in oil does not bankrupt the company. These strategies transform the stock market from a simple casino into a highly precise engineering workshop. Let us summarize what we have learned today. We discovered that option trading strategies involve mixing different financial instruments to create a custom risk and reward profile. By combining stocks with calls and puts, you can cap your losses, generate extra income, or even profit from pure volatility, regardless of market direction. Whether you are renting out your stock with a covered call or buying insurance with a protective put, these tools give you total control over your financial destiny. You have now covered the fundamental building blocks of mathematical finance. Mastering these combinations is the key to surviving and thriving in unpredictable markets.